I had to show you something this week that genuinely stopped me in my tracks. On the surface, everything looked fantastic. The S&P 500 hit fresh record highs in 2025. Financial headlines celebrated a 16% gain. Commentators talked about resilience. Political leaders pointed at the tape as proof that the strategy was working. But then I zoomed out, and what I saw completely changed the picture. Because while Wall Street was celebrating 16%, Canada was up 29%. South Korea surged roughly 80%. Mexico climbed around 25%. Suddenly, that great year didn't look so dominant anymore. When you rank the largest stock markets in the world by performance, the United States didn't even crack the top 40. For the largest economy on Earth, that's not a trivial detail. That's a signal. Then it gets even more interesting. The MSCI All-Country World Index ex-USA, which tracks major markets outside the US, gained roughly 29%, nearly double the S&P 500's return. That means, in simple math terms, you would have made almost twice as much investing internationally instead of staying concentrated in American equities. And here's what makes that unusual. Over the last decade, US markets have dominated. American exceptionalism in equities wasn't just a slogan, it was a performance fact. The US outpaced the rest of the world again and again, driven by tech giants, deep capital markets, and the global strength of the dollar. But 2025 wasn't just a bad year relative to peers. It may be something bigger, because at the same time US equities lagged, the US dollar had one of its weakest years since 2017. The world's primary reserve currency, the asset central banks hold for safety, declined meaningfully. Currency weakness by itself isn't catastrophic, but in context, it matters. And the context is this: countries are adjusting their behavior. Let's walk through the trade situation, because this is where the surface narrative and the structural reality diverge. At the start of 2025, the U.S. administration imposed broad tariffs on imports from multiple nations. The stated goal was straightforward: reduce the trade deficit, bring manufacturing home, force fairer trade terms, and rebalance global commerce in America's favor. If you listen to the political messaging, the implication was that tariffs would narrow the deficit and restore domestic production. But the numbers tell a more complicated story. The U.S. trade deficit in 2025 came in around $915 billion. In 2024, it was roughly $935 billion. That's a marginal shift. After a full year of aggressive tariffs and trade pressure, the overall deficit barely budged. Now here's the key detail. The trade deficit with China did decline significantly. It fell from roughly $296 billion to about $202 billion. On the surface, that looks like success, but here's what should keep you up at night. The trade didn't disappear, it moved. Vietnam's surplus with the United States jumped sharply, from roughly $123 billion to $178 billion. Taiwan's surplus climbed to about $147 billion, more than doubling in just a few years. Thailand and Malaysia saw substantial increases. The pattern is clear. Production shifted from China to other Asian nations. Supply chains rerouted. Goods still entered the United States. Americans still paid for them, often at higher prices due to tariffs and added logistics. But instead of reshoring, much of the manufacturing simply relocated. This isn't theory. This is observable trade data. Now, while this was happening, something remarkable occurred in Canada. For the first time since the trade tensions began, Canada posted a meaningful trade surplus. Canadian exports to non-US markets surged by more than 17% in 2025. The share of Canadian exports going to the US fell from roughly 76% to 72%. 4 percentage points may not sound dramatic, but in global trade terms, that's a structural shift. Canada actively diversified, and it wasn't just oil and commodities. Manufactured goods, technology services, and advanced sectors grew in non-US markets. In December 2025, Canada's exports to countries outside the United States reached record highs. That's not accidental. That's strategic repositioning. Meanwhile, Europe has been undergoing its own transformation. The European Union launched the Rearm Europe initiative, a program worth roughly $800 billion aimed at boosting domestic defense production. In addition, the Security Action for Europe, SAFE Fund, a $150 billion initiative, was structured in ways that significantly limit U.S. defense contractor participation. European leaders have openly stated a desire to reduce dependency on American military equipment. Germany increased defense spending toward 3.54% of GDP. Poland has spent even more relative to GDP. NATO's new long-term target moves toward 5% of GDP by 2035. That represents trillions of euros in cumulative spending over the next decade. And much of that money is being directed inward, toward European firms. This is not a short-term procurement shift, it's an industrial strategy. Now look at markets. European stock markets had an extraordinary year. Greece, Poland, the Czech Republic, and Spain were among the global leaders in performance. Germany's DAX reached fresh highs. The UK's FTSE 100 had its strongest year since 2009. In Asia, the story is equally striking. South Korea's surge was fueled by semiconductor demand. AI infrastructure requires advanced chips, memory, processors, specialized hardware, and Asian firms dominate large parts of that supply chain. The single most critical company in the AI chip ecosystem, Taiwan Semiconductor Manufacturing Company, saw its stock jump dramatically as global demand accelerated. Taiwan's market reflected that growth. Korea's tech sector rode the memory cycle. Mexico benefited from nearshoring trends. Put simply, global growth drivers broadened. For the first time in years, the narrative wasn't U.S. tech dominates everything. It was, the rest of the world is catching up. Now let's zoom out to currency dynamics. The U.S. dollar has long been the backbone of the global financial system. Oil is priced in dollars. Trade contracts are denominated in dollars. Central banks hold dollars in reserves. The U.S. benefits enormously from this arrangement. It lowers borrowing costs. It enhances sanction power. It strengthens financial leverage. But trust underpins reserve currency status. In 2025, the dollar weakened meaningfully. Central banks quietly diversified, modestly increasing euro and yuan allocations. Not dramatically, not in a panic, but incrementally. That's how reserve shifts happen, slowly, then suddenly. Here's what's different about this moment compared to past cycles. This divergence isn't happening because the U.S. economy collapsed. Growth remains solid. Corporate innovation continues. Capital markets are deep and liquid. What's changing is perception. When trade policy becomes unpredictable, businesses factor in political risk. When tariffs are announced abruptly, renegotiated, threatened again, companies adjust long-term supply chain strategy. Markets hate uncertainty more than they hate bad news. Uncertainty drives diversification. Foreign direct investment didn't evaporate from the United States in 2025, but some of it redirected. Mexico captured manufacturing flows that might once have gone to U.S. industrial states. Taiwan and South Korea absorbed tech investment that might have expanded American semiconductor capacity. Europe accelerated domestic industry development. The United States is not being excluded. It's being hedged against. And that's a critical distinction. For 75 years, the U.S. was the gravitational center of global commerce. If you wanted safety and growth, you invested in America. If you wanted liquidity, you used dollars. If you wanted technological leadership, you partnered with U.S. firms. Now the world is building alternatives. Payment systems independent of U.S. banks. Trade agreements that don't rely on American participation. Infrastructure corridors that bypass traditional choke points. Defense industries that don't depend on U.S. supply chains. None of this happens overnight. But once built, it doesn't unwind easily. Consider this carefully. If Canada builds stronger trade relationships in Asia, it won't abandon them simply because U.S. policy stabilizes. If European defense firms invest billions in new factories, they won't shut them down if American contractors re-enter the conversation. If Mexico replaces Chinese manufacturing flows, those plants won't close when tariffs are reduced. Structural changes are sticky. And here's the most important point. Leadership is relative. The United States doesn't have to decline for its dominance to diminish. If Europe, Asia, and emerging markets grow faster, if capital reallocates more broadly, the global system becomes multipolar. That's what 2025 might represent. Not American collapse, not economic disaster, but relative convergence. Investors are forward-looking. Buying foreign equities isn't anti-American. It's a judgment about future opportunity. When global fund managers reduce U.S. exposure and increase allocations abroad, they're voting with capital. That vote says something. It says growth is diversifying. It says political stability matters. It says industrial strategy abroad is gaining credibility. Now let me be clear. The U.S. economy remains enormous. American companies remain innovative. The depth of U.S. financial markets is unmatched. Silicon Valley still drives global software ecosystems. Wall Street still anchors global liquidity. That foundation doesn't vanish in 1 year. But advantages can erode at the margins, and erosion compounds. If trust weakens incrementally, if trade partners diversify gradually, if capital reallocates slowly but steadily, the cumulative effect over a decade is transformative. The question isn't whether America will remain powerful. It will. The question is whether it remains dominant. Will it continue to set the rules of trade, or negotiate within frameworks others design? Will the dollar remain overwhelmingly preferred, or simply one major reserve among several? Will U.S. equity markets command the majority of global capital flows, or compete in a more balanced system? Those are very different futures, and the signals in 2025 suggest the latter is becoming more plausible. This doesn't mean panic. It means awareness. The Canadian stock market outperforming isn't just about 1 year's returns. It reflects trade diversification, commodity leverage, and policy predictability. Europe's rally reflects industrial investment and defense expansion. Asia's surge reflects semiconductor dominance and AI infrastructure demand. The U.S. still participates in all of those themes, but it no longer monopolizes them. So what are we witnessing? It may be the early stages of a global rebalancing, a shift from U.S.-centric hyperdominance to distributed economic power. And that has consequences. Currency valuation becomes more competitive. Trade alliances become more complex. Investment flows fragment. Geopolitical leverage redistributes. Or, and this is possible, this could be a cyclical rotation. Perhaps U.S. markets underperform temporarily, then reassert dominance as innovation cycles mature and policy stabilizes. That's the open question. Are we seeing a structural inflection point, or a short-term correction amplified by headlines? Because if the world is truly diversifying away from over-reliance on the United States, then 2025 will be remembered not for record highs on the Dow, but for the year the global balance quietly shifted. And if it's temporary, then this will be a case study in how quickly narratives can flip. Either way, one thing is clear. The world is no longer moving in lockstep behind American markets. Capital is exploring alternatives. Countries are building redundancies. Supply chains are decentralizing. Defense industries are localizing. Reserve portfolios are diversifying. Not dramatically, not chaotically, but measurably. And when shifts are measurable, they're real. So here's the question that matters. Are we watching the slow end of singular economic dominance, replaced by a multipolar financial world? Or are we misreading one unusual year? What you decide about that will shape how you invest, how you assess risk, and how you interpret the next decade of economic headlines. Because sometimes the most important stories aren't the ones making the loudest noise. They're the ones quietly changing the structure underneath.